Well, a general partnership agreement is often the entity of choice for large farms, as it can aid in maximizing federal farm program benefits. However, partnerships can also present unique and complex tax issues. Roger McEowen with the Washburn University School of Law joins us now for today's Rural Money segment. Roger, as always, thanks for joining us today. So are partnerships subject to federal income tax?
Well, good to be with you, Janet. No, they're not at the entity level. The partnership's income and expense is determined at the partnership level. Then each partner takes into account separately on their individual return their distributive share. Whether or not it's actually distributed to them doesn't matter, but they take into account their distributive share of each class or item of partnership income, gain or loss or deduction or credit. That sounds simple enough. We just pass everything through the partnership to the individual partners, but the facts of a particular situation can make the application of that pass-through rule something other than straightforward.
So how does a taxpayer income tax basis actually play a role in all of this?
Basis is a really important concept, and the basis rules that apply outside of partnerships are the same rules that apply inside of partnerships. So we start with a determination of how you actually acquired your interest. Did you acquire your partnership interest by buying it, or did you inherit it, or was it gifted to you? And so we either get a purchase price basis to start our tax analysis, or we get a carryover basis if our interest was gifted to us, or we get what's known as a stepped-up basis equal to the date of death value if it's inherited. And that is where we start from determining whether we have gain or loss when we have an interest when we have income or an interest that is distributed.
So, Roger, what's the process for when a partnership distributes property or transfers the partner's partnership interest?
Well, we start with that basis issue that I just mentioned concerning the partnership, but there's an election that the partnership can make to adjust the basis of partnership property. And that allows a step up or step down in basis to reflect fair market value at the time of the exchange. And that has the advantage of not taxing a new partner if you're selling your interest to a new partner on gains or losses already reflected in the purchase price of that partnership interest. And so it gets really complex really fast, but there are certain elections that can be made, and we want to make those elections when we can, when we have a transfer of a partnership interest.
Roger, of course, this is a lot of information to take in. What would you say is the big takeaway to keep in mind?
Well, general partnerships can be very useful, and I think that's the main point. And, of course, as you said in the open, we like to use general partnerships from a payment limitation planning standpoint, particularly for the medium-sized and larger operations. And then if we want to limit liability, and, of course, a general partnership won't, then we own our interests in that general partnership in some form of limited liability company, for example. That's just one way to do it. But the point is, when we create the general partnerships, the tax complexity can ratchet up very quickly. So you really need good tax counsel by your side when you're forming these entities and as the process goes on through the ownership period.
All right, Roger, as always, thank you very much for your insight today. Roger McEowen, he's with the Washburn University School of Law, joining us on the phone today from Topeka, Kansas.